Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two of the biggest stocks in the world, and that is Microsoft and Apple before they report their quarterly earnings next week. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into Microsoft and Apple, I'd like to quickly break down the market just to give a better sense of what to expect from Microsoft and Apple and take a look at some of the earnings so far that we've seen. So the market jumped last Thursday following the release of some stronger than projected earnings reports from Walgreens, United Health, Bank of America, and some other economic bellwethers. Many of the big S&P 500 names also provided somewhat rosy guidance thus far in the face of global supply chain setbacks and other headwinds. Wall Street also turned its attention last week from disappointing September jobs data to last Thursday's weekly jobless claims that came under 300,000 for the first time since the pandemic began. This could mean that businesses are hanging on to their employees as many different sectors struggle to find workers. Stocks then popped Friday to see both the S&P 500 and the NASDAQ return to their 50-day moving averages, and the bulls have now pushed both of those indexes well above those levels to start the week of October 18th. This week we'll also see plenty more Q3 earnings results from big names with 73 S&P 500 names set to report. This includes Netflix, Johnson & Johnson, Snap, Intel, P&G. Obviously, there's still a ton of uncertainty out there heading into the winter and the holiday shopping period, and prices from goods and services to energy all continue to climb. P&G noted recently when they reported that they're going to have to raise their prices just because of supply chain setbacks heading into the holiday season. Nonetheless, the S&P 500 earnings and margin picture remains really strong, and the interest rate environment should certainly remain accommodating for stocks, even when the Fed starts to finally lift that core interest rate. And we've seen so far in the last week, we've seen the overall S&P 500 earnings picture for Q3 improve, which is a good sign so far in this early part of the earnings season. And then I wanted to quickly note one of our technical traders here at Zacks who runs Counter-Strike service noted on Friday, or actually on Monday, so yesterday. His name is Jeremy Mullen. He wrote just this simple thing. We only saw a 5% pullback, and I'm sure more people were looking for more. That means too many are short and underinvested. So if we do move higher, that panic buying will start again. So essentially he's saying that obviously people have been expecting a bigger pullback, maybe even a correction of 10% or more. We got, I think the S&P and NASDAQ both fell down around by at least 6% or more so far, but we're now well back closer to those highs. So he's saying essentially that if we see more positivity in the next week or two, you could easily see stocks run back up to print new highs, despite all of the uncertainty heading into the holiday shopping season. So with this in mind, Microsoft and Apple report their earnings results next week, along with all of the other huge FANG tech names. So we're going to take a look at Microsoft, which actually touched brand new highs Tuesday morning as well. So they're set to report their first quarter fiscal 2022 results next Tuesday on October 26th. And the stock is coming off another strong quarter and another stellar year. So it's quickly worth just looking back at the last quarter to give a sense of what its different business units are doing, since they're more diversified than ever. So its revenue climbed 21% last quarter, with Intelligent Cloud up 30% to account for 40% of total revenue. So it's that cloud business that's continued to push Microsoft higher, and it's really revamped their entire business to be a massive growth company again. Meanwhile, its office-heavy productivity and business processes space popped about 25%, and its more personal computing unit was up 9%. The company also noted that its search advertising revenue continued to expand. If you exclude traffic acquisition costs, it increased 53%, and it's continuing to grow within that booming digital ad market that's allowed many more players besides the typical Facebook and Google to benefit as more and more ad spending moves away from legacy media. We should also note that Microsoft's adjusted earnings climbed roughly 50%, and it's now topped our bottom line estimates by an average of about 20% in the last 4 quarters. As we just sort of alluded to, the company's expansion into cloud computing will continue to drive that growth alongside Amazon and others. And it's just going to be a necessity going forward. Microsoft is also increasingly invaluable really to its customers, from everyday users, people who use various Office products, to giant enterprises. And it's already really prepared for that hybrid work environment, which is happening as we speak, as it competes alongside Zoom, Salesforce, and many others. We should note that the company last quarter finished with $130 billion in cash and equivalents, and returned around $10 billion to shareholders via buybacks and dividends, which was up 16% from the year ago quarter. The company then on September 14th, so last month, raised its dividend by 11% to 62 cents per share, with that next dividend payable in early December to shareholders of record as of November 18th. So if you want to get in before that, it's not a bad idea to know those 2 dates. But if you're considering Microsoft as a longer-term investment, you don't need to necessarily worry about getting this early dividend payment or the next dividend payment they're making. The board of directors also approved a new share repurchase program authorizing up to $60 billion in repurchases with no expiration date. And obviously, it may be terminated at any time. But with this cash, Microsoft, Apple, and all of these huge companies will just continue to buy back their shares. And it's not like they're buying back their shares and not doing anything else with their money, because they also continue to make a slew of strategic acquisitions. Most recently, the company announced in mid-April its plans to buy Nuance Communications for $16 billion, making it the second largest deal under its current CEO. The company is at the forefront of speech recognition and AI, and its tech is set to roll into Microsoft's growing cloud business for healthcare clients and beyond. The companies also continue to make smaller purchases constantly. That includes nearly a dozen so far just in 2021. And we should note that I think I forgot to mention that it's a dividend yield that's 0.8% at the moment. Nothing outstanding, but it does top Apple, and it marks solid income for a stock that's continued to soar and crush the market for the last 5 years. So Microsoft's fiscal 2021 revenue, so that was last year, since we're heading into its first quarter earnings report next week, climbed 18%. Looking ahead, Zach's estimates call for its 2022 revenue to climb another 13%, with 2023 set to grow another 12%, all the way to $213 billion. So these projections would extend the firm's streak of between 10 to 18% sales growth to a whopping 6 years, which is a really impressive run for a company that went public back in the 1980s and showcases the strength and consistency of that cloud computing and reoccurring revenue that all of their various cloud businesses and those subscription models for all of its Office-related businesses are doing. Meanwhile, its adjusted earnings are projected to climb 8% and 13% respectively over this year and next. We should also note that its positive earnings revisions help it land a Zach's rank number 2 buy heading into its quarterly release, and all 19 brokerage recommendations that Zach's has are strong buys at the moment. So Wall Street remains really, really high on Microsoft, which makes sense. It's one of the biggest, most profitable companies in the world, which sometimes you don't need to get too cute with it. Just buy really good, strong, stable stocks. Microsoft is up 5% in the last month, and it hit brand new highs of $309 per share on Tuesday morning. So the last time I checked, that was the new highs. And the current Zach's consensus price target is at $326 a share, which marks another 5% upside. And then if we look over the last year, Microsoft is now up about 45%. This outpaces the S&P 500's 32% climb. And as we mentioned, it's bounced in the last month, trading at new highs heading into that earnings release next week. And then if we look back over the last 5 years, the company has outpaced Netflix, Apple, Amazon, Facebook, so all those other huge tech players, with it up about 440%. compared to Apple's 400% climb over the last 5 years. With that in mind, the stock's trading at about 34.2 times forward 12-month earnings at the moment, which is a little below, though, its year-long highs. And it does mark a discount to the broader Zacks computer software services market, which is trading at 36.6 times forward earnings heading into its release. So overall, if you're a long-term investor and you want to add a stable tech giant that's going to pay dividends and continue to buy back shares, even though it's at its highs, you don't need to be too trying to time the market and I'll wait for a pullback. If you're planning on holding it for a year or more, or way longer than that, if you buy it at $309 a share or maybe $300 a share, in the long run you might not notice. And if you're always avoiding the tops, you can miss out on big gains, which the last year and a half of the market has really proven that it's really hard to time the market, especially when we've seen stocks bounce back up above their 50-day moving averages in the last week or so. So now we're going to move on to another giant that hasn't needed an introduction for years, if not decades, and that is Apple, that's set to release its Q4 2021 results on Thursday, October 28th, so next Thursday. And like with Microsoft, it's quickly just worth running back over their last quarter because it helps give a sense of how broad-based their business is as they further solidified that non-iPhone business. So Apple posted blowout results last quarter with revenue up 36% and adjusted earnings 100% higher. The company's flagship smartphone helped drive that growth, though, with sales up 50% for the best iPhone growth in years. Apple also continues to enjoy strong expansion outside of that unit, with smartphone sales accounting for only 49% of Q3 revenue. So if you look a few years back, the iPhone would sometimes account for over 60%, especially in a big quarter where it saw a lot of growth. Meanwhile, Mac sales were up 16% and iPad revenue was up 12%, and the success of its wireless headphones and other devices helped its wearable home and accessory space jump 36%. We should also note that services unit was up 33% last quarter to account for about 22% of sales. So that continues to grow. It's going to be that nice reoccurring revenue, making it easily the second largest space behind the iPhone. One of the biggest points that needs to just constantly be reminded, and obviously saying to buy Apple stock is nothing new or mind-blowing, but for a company that sells high-end consumer electronics that millions of people crave, it pulled in $275 billion last year during a global pandemic. Its branding power is really unmatched, and its constant cycle of new phones and devices keep people wanting more. And really the fact that many consumers upgrade to new iPhones and other devices habitually, even if there isn't a game-changing difference or between the new model and their current smartphone, is just a sign of how impressive the company is. And many Apple customers rarely even consider buying anything other than an iPhone, opting to stay within that broader Apple universe for various reasons. So with this in mind, the company said on its January call with analysts that it reached over 1 billion active iPhones and 1.65 billion total devices. So last quarter, the company didn't provide any of those numbers, but they're likely even higher. And its CFO said in prepared remarks last quarter that it reached a new all-time high for our installed base of active devices. So Apple's long-term growth case is not that difficult to make in a world full of smartphone and device addicts, and that subscription business continues to grow, which is something CEO Tim Cook has really focused on, transforming the company beyond that iPhone to get those consistent revenue streams from its loyal and growing customer base of devices. So its App Store is obviously very popular, highly profitable. It also has Netflix and Spotify competitors, subscription offerings such as Apple Wallet, a video game platform, digital workout classes, tons more. Apple finished its most recent period with over 700 million paid subscriptions, up 150 million from the year ago period, and nearly 4 times the number of paid subscriptions it had only 4 years ago. So that business is booming, and it will likely continue to grow for years to come. The company also has brought many more of its chips in-house in its efforts to possibly one day create what it's referred to as a closed loop. Apple has also made news after like the last year plus, and it could still be rumors that it possibly could get into the electric vehicle space, though it's unclear about that. And we should note that the last year plus, they've spent a lot of time and money touting their privacy efforts, and that's now impacting Facebook and others' abilities to track users on iPhones. Apple does face some legal battles, which is not unusual for a company of its size. And Wall Street doesn't really seem worried about any of these specific suits, especially when demand for its first 5G capable iPhone last year has been really strong. Executives did note last quarter that they expect to see some supply chain setbacks in Q4, which they said were, quote, just greater than what they experienced during the June quarter. Still, the company just on Monday, so yesterday, unveiled some new products that will be available to buy as soon as next week ahead of the holiday shopping season. So the company showcased its new MacBook Pro laptops and an updated version of its AirPods with some minor tweaks also to the HomePod smart speaker line. And yeah, as I mentioned, you will be able to buy them without delay so far, which is a good sign heading into that holiday shopping season. And then there was also some more updates on its chip business. I read a Wall Street Journal article this morning about that I figured I would just quote directly from, since it's straightforward and succinct at the top. So this is from a Wall Street Journal article on Tuesday morning. So the new line of MacBook Pro models that Apple announced on Monday are the last of the Mac laptops to get the company's in-house processors called the M1. That comes less than a year after the company first unveiled the chip, which replaces the Core family from Intel as the computer's main central processor. At the time, Apple promised that it would move its entire Mac family to its in-house chips within, quote, a couple of years. It looks like it will be well ahead of schedule on that score. Following Monday's updates, Apple is now selling only 4 models of its desktop computers that still use Intel processors. 3 of those are available in newer generations with the M1 chips already. So I could go on, but the basic premise is that they're now even bringing in their own chips. So that's going to help the phones in the long term. And just it's going to be a big deal going forward as well. So Zacks estimates call for Apple's adjusted Q4 2021 earnings to climb 68% on 31% stronger sales. More broadly, its full year 2021 revenue expected to climb 34% from $275 billion all the way to $367 billion, which would crush last year's 6% sales expansion and mark its strongest top-line growth since 2015. Meanwhile, its adjusted earnings are projected to soar 70% this year, and it's still expected to grow its top and bottom lines again next year on top of this impressive 2021, with its sales expected to climb another 5% to roughly $383 billion, so adding a roughly $16 billion more. And obviously, these revisions or estimates could be revised higher if it's able to impress Wall Street with some solid guidance next week. Its earnings revisions have climbed since its last report, though it lands a Zacks record with their hold right now, and it's topped our bottom line estimates by an average of about 25% in the trailing 4 periods. The stock's also up about 4% in the last month, yet it still trades 5% below its early September records. As of Tuesday morning, it was trading at around $148 a share, and the current Zacks consensus price target is sitting at $171.68, which marks another 16% upside from its Tuesday morning price. So good to see there. And then overall, Apple is up about 30% in the last year, which actually lags the broader tech space, which is another positive sign. The Apple rarely lags the broader tech market for that long. So it's up 28% compared to the broader tech space's 37% climb in the last year. And we should note that Apple is trading, despite trading only about 5% below its actual highs, it's trading at 25.5 times forward 12-month earnings, which marks a big discount to its year-long highs when it was trading earlier this year at the beginning of the year at around 35 times forward earnings. It's also trading at a discount to the broader tech sector's 28.3 times forward earnings. The company also, just like Microsoft, is a cash cow, and it returns that money to shareholders through buybacks and dividends, $29 billion worth of that last quarter. The company also closed Q3 with net cash of $72 billion, and it will keep buying back its stock and keep trying to reduce its cash position. The company's massive piggy bank also allows it to pursue any new areas of tech that includes ones that really aren't even on the radar at the moment. Obviously, a big splashy acquisition doesn't seem like it's going to be in the cards anytime soon, though. You never know. People on Wall Street have been saying for years that Apple is going to make a big acquisition. It has not done that, but obviously its cash position could set it up to do that, or it could just continue to buy back its own stock and pay a dividend, which it will continue to do no matter what, even if it makes an acquisition. Like with Microsoft, Wall Street is extremely high on the stock with 17 of the 22 brokerage recommendations that Zacks has coming in at strong buys with none below a hold. So given this backdrop, now appears to be a solid time to consider buying Apple. And as we've stressed before, long-term investors don't really need to try to get fancy and think that owning Apple is too easy or that they need to find a hidden gem. You can certainly do that, but having Apple and Microsoft in your portfolio, if you're a long-term investor, is one of the closest things to a no-brainer at this point. And obviously, some people might want to wait for a bigger pullback, but as we've continued to say, if you're a long-term investor, trying to time the market is not necessarily the most advantageous thing you can do, as you're always going to then be trying to find the best entry point. And if you're going to hold the stock for 5 years, it doesn't necessarily matter as much. And obviously, there's always the option to dollar cost average into whatever move down Apple makes. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.